and make sure that they have a will drawn up. Definitely.
Yeah, it is. It's how important this is. So just for our viewers, nominated beneficiary is on a pension. You can effectively set how much you want your pension to leave in.
Yeah. There's some huge benefits of leaving it within the pension. So first of all, as we mentioned last week, it's outside of your estate for inheritance tax. With a pension as well, it's going to remain invested. So
when you've got children, sometimes it's actually not a bad idea to leave a little bit of the pension to the children, for basically just to get them involved in that. What would be your top tip to ensure that it's nice and easy for the family?
Make sure you've got your expression of wish updated, and make sure you've got a will.
Yeah. I was speaking to an advisor last week, and he says, I've got a black box in the house, and basically there's a key, and I've told my wife if anything happens to us, that's what she needs to open, and it'll tell them where everything is. Okay. Which is a little bit... I know. Good morning, good afternoon, or whenever you're watching this. Welcome to the Do More With Your Money podcast. Another week, episode 142. Can't believe we've got this far. 142 episodes, joined by a great panel today. Tom Robertshaw, financial advisor in our head office advice team. Luke Johnson-Bolton, one of our pension transfer specialists. And Jenny Lang, not Hall, used to be Hall, head of client service in True Potential Investments. Welcome, everyone. I think we've got a pretty good section to discuss today, securing your financial legacy, and just having a little bit of a discussion around what you should be doing when you're looking at planning for the future for leaving money to loved ones. Just before we do that, just a quick reminder, we don't have our standard True Potential Investments update this week, so please subscribe to the morning market videos. That will give you a little bit of a flavour of what's happened within the market today, which we've been pretty positive this week. If you like and subscribe, watch those videos, they'll give you a bit of an update from Jeff and the team. Let's get straight into the title of the session today, Tom, and I think we'll come across to you straight away. You obviously speak to lots of clients on a regular basis. What type of questions come up on a regular basis from your perspective when it comes to people concerned about leaving their money for their loved ones?
Yeah, I think obviously will planning is one area which does come up regularly, and that's an important conversation with clients. It's something that we have with clients at the end of the fact find process, actually, when we speak to them. Clients obviously need to speak to solicitors and will makers just to make sure, and look over the wills, really, because it is a very important topic. And one thing with, wills, which is important, is if you didn't leave a will, you would die intestate, which can, cause several problems, really, for clients. And, if you had, children and you were married, effectively, that money might not go to, your wife if you wanted it to go all to the wife, because if you were to die intestate, effectively, if you had assets over 270,000, then half of that amount of money over 270,000 would go to the children, and half would go to the spouse or civil partner. And also, it's a lot more time consuming as well, if anything happened to you. So I think will making is really, really important
It's interesting that, Tom, because I helped out a member of my family recently where they didn't have a will, and there was a lot of assets spread around. The gentleman in question was an avid investor. He had stuff with other different providers, etc. And the children had to sign in at station through a legal to ensure that the mum got the money. Because as you say, when intestate, it just shows you how important it is actually to set a will. You can sort out these things afterwards. I wouldn't say don't be...
it's a deed of variation you can normally use to sort that out afterwards, but it is, it
makes life so much easier, doesn't it?
And especially when you're grieving as well. I think that's like the last thing you want to be doing is having to sort out all of these different documents and pay more money to solicitors, effectively, which is what you'd be doing to do that. So, it's important. And I think the other thing with wills is there's like two types. Well, there's several different types, but the two main types are like a mirror will, which you just set up between your spouse or civil partner. But then on first death, the remaining spouse could actually change that will, whereas a mutual will, that's on second death, effectively, that's legally bounding, and they can't change that will. So it's important that clients speak to solicitors and will makers and will writers. And I'm not sure the technical word for them, to be perfectly honest with them. But it's important that they speak to those sort of people and make sure that they have a will drawn up. Definitely.
Yeah, it is. It's what you find when I did my will during COVID. Thought it was an appropriate time to set a will. And actually, it's good for two things. Obviously, it's good for the things that you say, but also just just really having to think about where you want your assets to lie, on your death, and also it's actually a written down document to show you where your assets could be. So it's actually quite an important thing on there. I think, Jenny, just kind of going to a true potential investment perspective, because I'm gathering we have lots of clients where sometimes we don't have a will, and it probably adds to the time. Would you?
Yeah, absolutely. Especially with the pension, can add an additional kind of, not guarantee, but almost kind of show what the expression of wish is reflected as. So if that matches, it's a pretty easy decision for the trustees to know where that payment needs to go or who the beneficiary is for that pension. From an ISA and general investment account perspective, the will again is really important, because that's going to allow whoever it is that is executor to go and get probate, so that they can start to sort things out. And without that will, again, it just makes the probate situation harder. It's more difficult to achieve. So the will massively helps the trustees make a decision as to who the beneficiary is for the pension.
And you mentioned nominate a beneficiary there, and I understand how important this is. So just for our viewers, nominated beneficiary is on a pension. You can effectively set how much you want your pension to leave, and because a pension's in trust, it then goes to the trustees and then they make the decision. So it effectively sits outside of the estate for will purposes. But we know there's many clients that haven't completed that, and that makes life difficult as well if they don't.
Yeah, it makes life so much difficult, and especially as Tom said, at a time where families are grieving that loss, us not having an expression of wish on file, it means that we have to go around digging for information. We have to ask questions that really we don't want to be asking. So it's so important to make sure that you do have that expression of wish noted on file, and you can change it at any point. You can go into your client site, click on your pension, on the details tab. If you scroll down a little bit, it shows you who's your current nominated beneficiary. And if you want to change that, that's absolutely fine. You can also include charities if you wish to do that, but it's so important that that's there.
Yeah, so you go and there's actually a banner on the website to get people to complete these at the minute. So it's something we're pushing, because we think it's important for planning purposes. Tom, go back to you. So we tend to typically beneficiaries. For myself, my wife Annie is my main beneficiary of my pension. But actually, when you've got children, sometimes it's actually not a bad idea to leave a little bit of the pension to the children, for basically just to get them involved in that conversation. Would you say?
Yeah, absolutely. And you can set up a beneficiary pension as a result of that for that child. And I think it's really important that when we're talking about pensions, we're educating the next generation on them as well. And a lot of people might get a beneficiary's pension and just take it all out and actually forget about the fact that they can use that as a pension themselves in later life. And especially with the crisis that we've got with pensions, and then employers obviously not making as large contributions into pensions, with defined benefit schemes being almost abandoned in some areas now. It's really, really important that those who do receive beneficiary pensions can actually just try and keep them for the purpose of a pension, really, more than anything else.
I think as well, it's you've got to remember that even when it goes into the beneficiary pension, it's still in that tax wrapper, and you can draw from it as a beneficiary pension as and when you need to. It's not like you're locked in until you're 55, or you can only take from when you're 55. You can take as and when you need.
There's some huge benefits of leaving it within the pension. So first of all, as we mentioned last week, it's outside of your estate for inheritance tax. With a pension as well, it's going to remain invested. So the true potential balanced portfolio, which most of our clients are, that's going to be inherited by your children or spouse, and it's going to remain invested in roughly 60% equity. So if we talk about having a sort of a fight against inflation with these investments, think of a pension is going to be a long-term investment for a client. It could be 30, 40 years, but actually if you consider you could leave this to your children as well, this could be an even longer sort of a time period where that's going to remain invested. So it's quite important that we consider, not to take it from the pension, leave it within the pension, that can be left to children, etc. And you could have a 100-year time frame whereby it's going to be invested in sort of equities, try and combat inflation. So that's something to consider with regards to wills and pensions especially. It's something that's going to be outside of your estate. It's going to be tax-free on death under 75 as well, so your children can access quite a substantial final salary pot that may have been transferred, or a large workplace pension. That could be worth several hundred thousands of pounds. That could be tax-free, and also can be left invested in the most tax-efficient wrapper you're going to have. It's going to have tax-free growth. and it's going to have obviously tax-free income as well alongside it, as well as being invested. So something really important to consider, especially when considering, you know, death benefits of pensions, personal pensions.
So Luke, you're dead on, and I think you make some real valid points about pensions, and I think sometimes we're kind of looking at. I had a good conversation with a lady whose father sadly passed away a few months ago, and one of the conversations she said to me that was, he was sadly dying of cancer, so he was aware of it was terminal, and he sat down with the family and he had a discussion around, you know, their options with them, and that's an uncomfortable conversation sometimes.
Yeah.
But actually, I think sometimes it's good to bring that type of conversation in with your family to discuss. You know, you don't have to kind of talk in pounds and pence what they've got, but you can try and educate them in terms of their options. You know, if something happens to me, this is what you'll get. This is my financial advisor. I've spoken to lots of advisors recently where they're starting to the children are starting to become clients. And we say children because, you know, it's adults now. It's people growing up, but
children,
they're starting to become clients. And I would suggest if you know, with us as an advisor, bring your advisor in and bring your children into these conversations so they're aware. You know, little things like getting those to save or looking at their pensions, etc. Because sometimes if you take it, especially with a pension, if you just get a lump sum in one go, stick it into a bank account, actually there's some real negatives to that.
Yeah, and that could be the knee-jerk reaction to take this pension and put it in a bank account where you could get 2-3% interest at the minute, and maybe a little bit more with the way interest rates are going. But ultimately, we would expect equities to perform at a high level over the long term. And as I mentioned before, this could go to your children, it could go to their children's children. It would always pass tax-free once it's passed through once. So yeah, it's really important to have that quite large asset to remain invested, and also consider the options, because once you've taken it from the personal pension, it's very hard to replace it and get that back in within the tax efficient wrapper of a personal pension.
I think one thing I'd add to that as well is just with, I know last week we sort of looked at inheritance tax planning and good routes for inheritance tax planning, but if you look what other options are out there for inheritance tax planning, you're looking at trusts, which are quite complicated and actually quite inflexible as well at the same time. So I think this whole thing of actually speaking to your children earlier on in your life, especially if you are in that position where you say fortunate to have an inheritance tax liability, but I suppose it's unfortunate in some senses as well. You can start planning and putting money into pensions, every year, and maximising your allowances for pensions, and that's by far the most flexible way that you can put money outside of your estate, and that money is outside of your estate immediately as well, which is whereas with trust you've got to wait 7 years with that, and they're a lot more complicated and higher charges, and sometimes they're certainly suitable, but I
think it's important to note as well, you mentioned it, unfortunate to have inheritance tax. So if you look at the actual brackets, which I know we covered off in depth last week, but just to touch on that quickly, for someone who's single, not married and no children, they're going to have an inheritance tax band of 325,000.
Yeah.
I think you can compare that to the average house price in the UK. That's not too far off. So for someone who's at retirement or near the average life expectancy in the UK of 85, 86 for a male, and they have a house with no mortgage, they're likely to have an inheritance tax issue. So it's important to consider that, and therefore know that pensions are obviously outside of the estate for inheritance tax purposes.
Yeah, and also consider that although you might be taken out of your pension, and that reduces obviously how much you can put in, there's actually some benefits of later on in life of contributing to your pension, especially if you've got an inheritance tax problem. I don't know if either of you want to have a little discussion about that, but you can. It's the pension's not just a product that you save till you're 55 and you go, right, well, that's it, I've saved from your retirement.
Of course.
There's other benefits, isn't it?
Yeah, of course there is. So again, for someone, maybe someone single or married who may be approaching retirement or retired, so say they're still working and making employer contributions, there could be tax benefits to therefore putting more into the pension in the first place, and tax savings for them there. But if you know that you're over the inheritance tax band, which, as I've covered before, a lot of people could be without even realising it, if you have a property and some assets, then you could be over that band. It makes sense for yourself from a tax perspective to put more into the pension, and then on death there's going to be less in terms of the estate, and there's going to be less inheritance tax to pay as well. So it's always worth having that conversation with your advisor if you are interested, obviously, in having that sort of extra contributions into the pension.
And I think, Tom, I'll bring this across to you because I think this is really important. If you're unsure of anything that we're kind of discussing on, do I have an inheritance tax problem or have I set my beneficiary? That's where we're here. That's why your advisor's here.
Absolutely. And it's something that when we're looking at clients' positions, especially even on a drawdown perspective, because that's when we need to look at inheritance tax planning quite a lot of the time. Because if you do have an inheritance tax liability, well, you should be drawing from assets that fall within your estate rather than drawing from your pension assets effectively. So that's a conversation that we have with a lot of clients, and whenever we see, from an advisor perspective, we've got a fantastic back office system where we can see all the information on a client, and whenever we look through the fact find, when we get it, we'll be looking at the inheritance tax position, because that is actually quite an important thing to look at, especially like I said on withdrawal. And it's something that we can calculate and work out for the client when we go for the fact find with them.
Actually, worth mentioning as well, there's a feature on the fact find, which is your personal details section. So when you're trying to give advice to an end client, and or an advisor's trying to give an advice to an end client, it's actually really important that we have the full picture. So if you go on your client website, you look at your personal details section and look at your assets and liabilities and other sections, make sure that's completed correctly, because that'll, when, as Tom says, when there's a meeting with your advisor and that's up to date, they can spot these things and go, well, actually, we can maybe do something that can support you in terms of that planning. It's difficult to give full proper advice unless you know the full picture.
Yeah,
absolutely. So worth just a plug off on that. Just going back to the children, Tom. I'm kind of like saying children because I was maybe saying non-dependents, because when is the right time to have that conversation with your children?
I mean,
it's difficult in terms of ages. You're not going to go and speak to your 10-year-olds and just tell you where your pension is. But actually, we'll have many clients who've got older children, and they might not have had these discussions yet.
Yeah, I mean, we obviously learn in the textbooks it's like sort of age 60 onwards really, but I think it should be earlier personally, especially if you've got a large estate, because the earlier you plan, especially if you're gifting money away, you might be putting into pensions, but you might also be gifting assets away to your children as well, and you've got to remember you've got to try and survive that 7-year rule with that.
Talk about the gifting a little bit. That's actually quite
absolutely. So if you just gift, first of all, you've got an annual exempt amount, which is £3,000, and you can carry that forward as well, so you can have £6,000 each with your annual exempt amount. Gifts into charity are exempt from inheritance tax. But I mean, one thing, a lot of people don't actually realise that you can gift above that £6,000. You can actually just gift to your children, and as long as you survive 7 years, that falls outside of your estate. It's classed as a potentially exempt transfer, effectively. And I think it's one that isn't looked at enough. I mean, we always say you should look at your pensions first, and then you should look at gifting afterwards if you've got the capacity to do so. And then obviously, if you want control over that money, you can look at trust planning as well, and that involves obviously a different area of this. But I think gifting is certainly a good thing. But what you've got to focus on if you're going to gift is you want to make sure that you've got enough in your retirement to meet your needs. That's the first priority before you even look at.
It's all nice and well having an inheritance tax problem, but if you run out of money before,
exactly,
I totally agree. And I think it's worth saying that gifting isn't just here's a bag of money and thanks very much. It can be actually gifting and setting up an ISA for
absolutely,
and having that discussion with the beneficiaries. It's funny now, since personally me, I think Luke and I we've talked about this because we've both got with children. My outlook on life changed very much when my son was born. And that was kind of the point where I was thinking, right, I need a will. But actually the other areas that I was thinking about was, does my wife know where everything is? Do I know where all her assets are? Because, we have lots of joint things, but we have, quite like many people, we have lots of separate things. So it's kind of, I was speaking to an advisor last week and he says, I've got a black box in the house and basically there's a key. And I've told my wife, if anything happens to us, that's what you need to open. It'll tell them where everything is. Which is a little bit... I know, that's what I was thinking. But
everyone's going to be searching for black boxes.
And it's one of these things. We've got the document storage section on our site, and it's worth using that to bring these sorts of shared documents in. We are, as a business, looking at how we can offer like a beneficiary website. So I'm giving a little bit of a taster here to people. So you can kind of share these types of documents and basically give access to your beneficiaries on death and things. So we're looking at that. And I think that's going to be a good feature for us. But yeah, just I think kind of adding to that, that's now something I thought about, which was if you kind of there's two things you think about. One, does everyone know where everything is? But like, if something happened to me and my wife, then does my son know where everything is? So it makes you think differently, doesn't
I
it?
think definitely, yeah, obviously having children, it does make you consider your financial future a little bit more. I think one of the great things of getting a will sorted is that you sit down and you list all of your assets, all of your liabilities. So it gives you a chance to just sit down with an advisor or legal professional and say, this is what we have, this is where it's going to go on death as well. But yeah, definitely, that's one of the good points of looking at a will and having children. Obviously, it's definitely something to consider.
And it's never too early and never too late to do it.
Yep.
I think this is the key. It's like, you might think, oh well, you know, I'm only 25 or whatever, or 35, or lots of time in life, but actually, that's probably the time you should be doing it, and regularly review it as well. Yeah. And you know, you should regularly look and change, because it just makes life a lot easier. Yeah. It's not a nice thing to talk about, but it's actually, I think you want to make sure. Our job when clients are paying us for servicing, our job is to look after their assets and those as clients, but also their family moving forward.
I think one thing with the will as well is, remember, if you get married, that if you made a will before, that revokes that will. So make sure that after you're married, you've certainly created a will.
Oh, does it? I didn't.
Yeah.
Oh, there you go. So if I get married again,
yeah,
I need to do another will.
You're doing your will.
Right. Okay. I bet people have fell foul of that sometimes. Just probably it's a valid area, valid point. Right. I think just finally we'll just finish on a bit of I know we talked a bit about this last week, but inheritance planning. We've talked about trusts. We've talked about gifting. Where do we, Tom, where do our clients go for this type of advice? You speak to their advisor on a regular basis?
Yeah, I mean, absolutely. I mean, I've done all sorts of, cases for clients. We've done trust planning cases. We can certainly do that for clients. And trust planning is very specific to certain, you've got to have a certain set of circumstances to be able to actually justify, recommending a trust, really. But I always think that the best way of trying to plan from an inheritance tax point of view, really, is just looking at your pensions early on, whenever you can. If you've got any inkling that you might be, going above that threshold from an inheritance tax point of view, and then try and put as much money as you can into that pension, because it's just by far the best product from an inheritance tax point of view.
I think it was Luke said before, but let's just go through those numbers again. Then
yeah, of course. Yeah. So I always look at three separate. So it depends on your personal circumstances. So everybody who is single with no children will have 325,000 inheritance tax bracket. And once they breach that, it's a 40% charge. For a married couple, they have 325,000 each, so a total of 650,000 for them, and that's payable on second death of yourself or your spouse. If you have children, there is an extra 175,000 each, and that's called the main residence nil rate band, and that means your property can be offset by a further 175,000 times 2. So for a couple who are married with children, they effectively have a 1 million main residence nil rate band. So it all depends on your personal circumstances, and if you are concerned about inheritance tax, then I would recommend speaking to your advisor, because it can be quite a complex area.
And there's also as well, especially when you look at house prices, I mean, that's one of the main influences with inheritance tax, especially in areas of central London where we deal with clients quite a lot of the time where the main residence is actually worth over the nil rate bands.
Of course, yeah.
And £1 million is a hell of a lot of money, but actually when you take into account some property, when you take into account property prices, it can impact some more than others. And unfortunately, when you've got that position where your property's over that £1 million mark, then there's not a lot you can obviously try and reduce that inheritance tax liability, but unfortunately you might actually pay inheritance tax unless you downsize your property. So we've got to look at all of those different options with clients.
And I think the thing is that the sort of title of this podcast is Secure Your Financial Legacy, and people lucky enough to have an inheritance tax problem, then discuss with an advisor. Even if you don't, it's actually worth discussing to make sure you've got the planning correct, to ensure that your loved ones do, because what you want to do, you don't want any hassle. Personally, that's in my head, but I'm when I've set my will, I've done it for a reason. I want to ensure that if something does happen to me, that my family are fully aware that they can inherit everything that I've earned. So I think that's really important. Yeah. It's really important. Jenny, I'm going to let you finish off here, because I know that you spend a lot of time with clients and clients' loved ones, ensuring that they that they do get the assets that are left from their family. So what would be your top tip to ensure that it's nice and easy for the family?
Make sure you've got your expression of wish updated, and make sure you've got a will. And I'm actually quite a bit of a hypocrite, because I don't have a will, despite the fact that my next door neighbour is a will writer, or whatever it is. So my task for this weekend is to definitely look at that, especially after hearing obviously some of them figures as well. So but absolutely, expression of wish and will.
Yeah, I totally agree. Get that sorted. it's and also you'll be able to find out more of what Greg's got that he's not telling you about.
Exactly. Or maybe I'm more worried about him finding out what I've got and he doesn't know about. So
Searching for that black box. There might be two.
There'll be a big black box if it's Greg. Great topic. Thanks everyone. I really appreciate your time today. Some good, some real good points. And I think it's in summary. I think I say this every podcast, but we're here for you. I think this is the key thing. If you've got any concerns about what we've discussed today, or if you just want to talk to an advisor about your investments, etc. We know it's been an interesting and tough year. I think we can all accept that. But we say tough times, tough people last tough times or something. Is that the saying? I can't remember what Dan was saying. But so I think it's key. We're always here for you to discuss and go in a bit more detail if you wish to discuss these points. That's what the experts and that's what we're here for. So thank you very much, everyone. Hopefully you all have a nice weekend. And just a quick reminder: please like and subscribe on the podcast. But thank you very much. Hope everyone has a fantastic weekend. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.